We're in the midst of what is a pretty sizable sell-off.
Today, markets do take a nosedive.
The unemployment rate unexpectedly went up.
It's over. It's over.
That's it. I've had it with this dump. Our pets' heads are falling off.
Hi, everyone. Jake and Robert back here again with Ask Avidian. Robert, market's down quite a bit. Intel dropping 20% this morning. Our kids' pets' heads are falling off. What's going on in the world of financial markets today?
So what's going on is that everyone just needs to take a deep breath, right? We've had a great run up to this point with the markets. We're still up, year over year, and it makes sense that there'd be a little bit of pullback now. With what I'm looking at, the people that are panicking are the ones that really don't understand where they are now versus where they'll be in 6 months, a year, 2 years. There's not really a good cohesive plan making them feel confident that the navigation moving forward is going to put them in a good position.
What advice would we give somebody today if we wanted to put them in a good position to either succeed in this type of environment or maybe even better yet, have peace during this type of environment?
Yeah, the old adage that, time in the market is better than timing the market, it holds true. As lame as it sounds, because everyone throws that out there, it's really important to remember. And I think from a planning standpoint, understanding your time horizon helps you with allocation. But more importantly, I think that if you're going to be navigating up and down markets and being a long-term investor, you need to be able to identify safe cash positioning versus risk-on positioning. And during these moments where there's market pullbacks, if you plan correctly for them, you don't look at them as some kind of horror show, where pets' heads are falling off. Instead, you see it as a buying opportunity for long-term investing. That's where you can take that safe cash position that you don't really rely on and slowly feed it into the investments that you believe have long-term success waiting for them.
So let's boil that time horizon thing down just a little bit, right? If I see the market correcting, but I have a cash position set aside, number one, I know that I have something to get me through and weather the storm. But then for the things that are correcting and that are selling off, buying opportunity, and maybe we should just go back a little bit to some financial market data from past corrections to give us, again, a little bit more peace. If we look out periods of 5 years, 10 years, and longer, there are really no major examples where a correction did not rebound and then you end up in a better place going out 5 or 10 years.
That's right.
So time, make it work for you, right?
That's right. And I think also if you're trying to think to yourself, okay, let's say I take your advice and I see this pullback as a buying opportunity. How do I execute in the most efficient way possible if I can't time the market? Right? You don't know exactly where the bottom is. You don't know where the high is. How do I get this money invested correctly? And I think the best way to go about doing that is first ask yourself, when will I need this money? And this goes back to the time horizon component. When will I need to pull on this money, either for expenses or something like that? But if you're a long-term investor, you don't really have to worry about that. You just need to figure out, how do I integrate it over the next few months or the next year? And this is where planning for dollar cost averaging is really critical. Because rather than trying to time the absolute bottom and go all in, you slowly integrate the money either over weeks or months, and that winds up being statistically the best way to get into the market during these pullback periods.
So, Robert, I know we're talking about getting in and out of the market, right? But I know some of our listeners are more kind of do-it-yourselfers. Some of them might like picking their own stocks. When we look at financial planning, we look at what we kind of consider to be, high reliability, high probability scenarios in the world of financial markets. We're typically not looking at an individual stock or a very small undiversified basket of stocks and saying, this basket is going to be in a better place 5 or 10 years out, right? We're thinking of broad market, broad brush, diversified stock portfolios. Is that correct?
That is correct. Who was it that said diversification is the only free lunch?
I think that was our buddy Harry Markowitz.
Oh, okay. You might know a little bit more about him than I do. What do you think he meant by that?
Well, there's a mathematical answer. We don't need to get into that. But really what it means is spreading your bets. You can find lots of bets that have high return potential, lots of bets that have, intermediate return potential, but having more bets that could potentially pay off preserves return, right? So you don't have to give up your hopes and dreams from a financial perspective. This is not, well, if I don't own this one stock, I own cash, right? Where your return goes down. It's, spreading your bets. Your return expectation shouldn't really be unchanged, but your risk decreases, because when one thing is not working in your portfolio, something else should be working in your portfolio.
So, Jake, we're talking about broader market investments. I'm thinking indexes and other types of diversified baskets people can go into. Are there any other options that we haven't considered or talked about?
So you're asking, could there potentially be an alternative to stocks and bonds in your portfolio?
That's right.
That's a great lead-in, Robert. I'm glad you mentioned it. So we do a lot of work at Avidian in the alternative space, both in things that we consider to be liquid, where you can trade them every single day, and things that are illiquid, where you have to invest and let your money sit for a number of years and sometimes even longer. We introduce those into portfolios for the same reason that we don't buy, 5 or 10 stocks in a portfolio. We introduce those mainly for diversification. If you were to look at what's not working today in the markets, right? Most equities are down. So even if you had a diversified basket of equities, you're probably still down a little bit in your portfolio. Fixed income this time is up, right? Because interest rates have come down. So there's a little bit of diversification there. But what you won't read in the headlines very often is what alternatives are doing in these, daily market sell-offs, daily market volatility events. Number one is because a lot of times it's just not that interesting. If the stock market's down 4, 3, 2, 1% in a given day, alternatives probably are not doing much in correlation with that. That's why we like them in portfolios, right? Your equities can be suffering, your fixed income might be suffering, but you'll have this other basket of investable assets that should be working well in those scenarios.
I think there's a bit of misconception around alternatives, because when I talk to people, they often think that there are these small pocket deals that you kind of have to know somebody who happens to be related to someone's uncle in order to get involved with them. But alternatives, I think, make up a much bigger portion of the wealth in America than we give it credit for. Is that right?
That's a great point. And really, to answer your first question, in the pocket deals, all you really need to know is Avidian. You give us a call, we'll get you in some good stuff. But just kind of all joking aside, when you look at the alternative space just in general, there are, I think it's about 90% of the companies in the U.S. that have revenues above $100 million are private companies. And those all kind of fall into this alternatives basket because they're not publicly traded. And so just by opening up your portfolio to those potential investment opportunities, you take your potential investments that you can make from maybe it's 4,000 public companies to 40,000 plus companies in the public and private space. So you get a lot more places you can place capital.
So, Jake, it sounds like there's a lot of different options and, frankly, opportunities to explore within these markets. And outside of turning on CNBC and just doing whatever Jim Cramer says, which doesn't often work out too well, what are the things that people can do right now to start taking advantage of these opportunities?
Well, I mean, something that we always recommend is having a financial professional as your trusted partner. If we think about alternatives as just an easy example to point to, there's just such a large range of potential opportunities, potential investments. There's a lot of good ones out there, but there's also a lot of things that you want to avoid. So it's helpful to have a partner there, somebody that knows the industry, knows the market, knows the landscape. But that goes beyond just picking investments and populating a portfolio. We really think that you need almost like a financial coach, somebody to kind of hold your hand, go through the training exercises with you, go through the tough times with you, right?
And that's where we come in, because at the end of the day, the due diligence factor has two components to it. One are the investments, and two is the personal financial side. Most people tend to not do a great job at either of these when they're operating alone. That's why any successful business or person typically surrounds themselves with a team to help them do this. So if we look at the personal due diligence, believe it or not, when I sit down with people and talk about financial planning, they actually usually do not have a good comprehensive understanding of where they are financially, what they can afford today, what they'll have to have tomorrow in order to afford what they're buying today. And that kind of sit down and conversation is really important when discerning things like what type of diversification do I need in my portfolio, what type of cash flow do I need from my portfolio, and when do I need to accomplish this all by. And then, of course, there's the other side of the coin, which is typically where you and your team come in, which is the due diligence of the markets and the different sectors and the different companies that you can add to your portfolio to really optimize that wealth aggregation over the long term and make sure that the short-term impact that's happening in the markets and that's happening with your personal pocketbook is not messing that up.
So, Robert, if I'm getting up in the morning and I'm going to work and I see the headlines and I know that my portfolio is down, 3, 4, 5%, whatever that number happens to be, I could choose two things, right? I could choose to go to the office, worried about it all day, maybe take a lunch break and try to figure it out on my own, or I could choose to have a financial professional who I know they're going to the office too. They're working on my problems all day long, right? That's my financial force multiplier. I can have that individual figuring all this stuff out, and I can just kind of go about my day with the expectation that by the end of the day, if there's something that I need to do, they're going to notify me of that thing.
That's exactly right. And that's why it's so important to surround yourself with people that you trust and that you know have a track record of solid performance and solid advice to help you navigate these instances of market volatility.
Robert, that's a great point. I've had a lot of fun talking about this today. Even when things are going poorly in the markets, there's always opportunities, always money to be made. So we know that we got to go home, we got to hug our pets, we got to make sure we got the right financial team in place. And if you don't think you have that team in place, just come check us out on avidianwealth.com.